afternoon, everybody. Uneducated Economist. 28 people already here in the live stream. That is so awesome. Hitting that like button. 23 likes already. Let's keep hitting that like button as you come into the live stream. The YouTube algorithm will pick up the video, spread it around for more people to join in. So it looks like Jerome Powell has come out and stated it is now a matter of how much, but not a matter of if. We are definitely cutting at the next meeting, so he says. And let me see if I can get this right. He is going off of now the inflation has declined significantly. The labor market is no longer overheated and conditions are now less tight than those that prevailed before the pandemic. Supply constraints have normalized and the balance of risk to our two mandates has changed. Now, of course, I'm just reading from a news article, so it doesn't go into too much depth of it. But ultimately, the 100% chance of rate cuts taking place here in the future seems to now be within the markets and within the speak of the Federal Reserve. Now, this is exactly what I was looking for to confirm the credible threat. Now, you're going to see the markets begin to react as if those, and if they haven't already, considering how much I've already confirmed that there was going to be a 100% rate cut. But now it's just a matter of positioning themselves for those rate cuts and not knowing exactly how much those rate cuts are going to be. So the Federal Reserve still has a bit of an open-end credible threat to the interest rate cuts that are coming. Now, something I found very interesting is that as I read through a lot of the mainstream media articles, I begin to get this feeling that it's not a matter of trying to combat a recession. This seems to be just being somewhat accommodating, if I'm getting the gist of it right. Now, again, you could probably find some articles that are saying they're doing this for recession reasons or election reasons or all kinds of stuff. But ultimately, when you hear what Jerome Powell just said there about easing inflation and labor markets and all that other stuff, it doesn't really seem to me that they are trying to combat or resist or deal with a recession, like typically you would find coming from the Federal Reserve when they begin to lower rates. Like they're trying to stop the recession from happening. Ultimately, they lower rates right into a recession. Now, here's an interesting thing that I found. I left a link down in the description for you. And this is coming from a working paper dated, what is this? This is back in like 2002, if I remember right. Let me see if I can find a date on it. Yeah, I think it's 2002. But I don't have an exact date on it. It's a working paper here. But this is really interesting stuff. Now, the title of this is How Robust Are Make-Up Strategies to the Key Alternative Assumptions? Now, this is a really, really long one. I'm not going to read through it. It's 40-something pages long. Maybe we'll cover a bunch of it in a live stream someday. But I just want to read through the abstract of this and kind of give you an idea of what it is that the Federal Reserve is thinking when they go to make the move. Now, let me just read the abstract so we can kind of get an idea of what this paper is going to talk about, and then I'll find that little section that I want to share with you. It says, oops, let me put these things on. We now analyze the robustness of make-up strategies, policies that aim to offset, at least in part, past misses of inflation from its objective, to alternative modeling assumptions with an emphasis on the role of inflation expectations. We survey empirical evidence on the behavior of short-run and long-run inflation expectations. Using simulations from the Federal Reserve Bank U.S. macroeconomics model, we find that the make-up strategies can moderately offset the real effects of adverse economic shocks, even when much of the public is uninformed about monetary strategies. We also discuss the robustness of make-up strategies to alternative assumptions about the slope of the Phillips curve and the misperceptions of economic slack. Now, it's pretty confusing when he's going into this, but ultimately, this paper discussed to the heart all the credible threat theories that are out there. This is really diving into forward guidance and how it is that forward guidance deals with the inflation expectations going into the future. Now, again, I don't think we have time to sit here and read through all of this, even though I would love to do this in a live stream for you. What I am going to do is I'm going to come down to page, I think it's 11 in the PDF file. Get down there. Yeah, page 12 on the PDF, actual page 11 marked on the page here. But I want to read through this particular paragraph because I believe this is very telling about what it is that the Federal Reserve is trying to communicate, because it's very important to understand how it is that they are communicating it to the public, to the people out there, and how the people receive this. Now, evidence, this is from this working paper here, and again, there's a link down in the description. This is on page 11 of the PDF. Evidence also exists that inflation expectations are responsive to policy decisions. In particular, Federal Reserve communications in the wake of the Great Recession, mainly forward guidance, lowered expectations of the future path of the federal funds rate. The effects of the forward guidance on growth and inflation expectations are more difficult to assess because they depend on the public's interpretation of the guidance. Okay? Try and stick with me here a little bit. This Fed speak is really difficult. You gotta kind of read it over and over again, and then finally it kind of clicks. Let me read that sentence again. The effects of the forward guidance on growth and inflation expectations are more difficult to assess because they depend on the public's interpretation of the guidance. An unexpected loosening could lower inflation expectations if the public interpreted this action as the Federal Reserve predicting a weak economy in the future. If the public instead saw the change as simply reflecting a more accommodative policy stance, inflation expectations would be expected to rise. Did you hear that? It's the same action, two different outcomes. Did you guys catch it? Let me read it again. An unexpected loosening could lower inflation expectations if the public interpreted this action as the Federal Reserve predicting a weak economy in the future. This would lower inflation expectations. If the public instead saw the change as simply reflecting a more accommodative policy stance, inflation expectations would be expected to rise. This is really them saying that the interest rate movement really doesn't mean anything to inflation, right? See, that's where, like, if you believe the Federal Reserve is doing it for this reason, it will have this outcome. If you believe the Federal Reserve is doing it for this reason, it will have that outcome, even though the action that they are taking is essentially the same. And that's really how the credible threat works. This is why the makeup strategy is so needed within your understanding of what it is that the Federal Reserve is doing with their monetary policy. I left a link down in the description. If you just go through the first 10 pages of this thing, and I know it's work, it's hard, it's got to go through all this Fed speak, but you will see the problems that they were facing due to the fact that they could not get the inflationary scenario after the great financial crisis. They had run into the lower bound of zero. They were out of monetary policy. And they came up and formulated ways to communicate to the people out there in ways that then conducts their monetary policy for them. In the facts that they don't have to use the interest rate adjustments. This is explaining how this works right here, okay? And they're basically saying if they look at this adjustment and they're shocked by it, and they think that they're doing it to try and save the country from a recession, then it will have this outcome. If they're thinking they're just being accommodating and not doing it out of an economic shock, then it'll have this sort of outcome. And it's the opposite outcome, but yet the action that they are taking is the same. It's the communication that was different, right? And how the people receive that information. And that's the difference inside of how it is that most people are misunderstanding the Federal Reserve. Like, you think about it, the interest rate cuts that come in September won't really have an effect on the economy for 6 months to a year. So we have a long time to go before we actually really feel the effects of the interest rate cuts. But think about what the market is going to do. The market has already taken action. They're already positioning themselves, and nothing has happened yet. They still haven't done anything with rates. But now that the people have been well communicated to, they will take action. They will start to put themselves in those positions to get the quarter point or half point or whatever it's going to be. And if it's delivered in a particular fashion, it will have an inflation expectation to it, or it'll have one that rises or one that falls, depending on how it's communicated, regardless of what the action is itself. So anyway, I'm going to leave it at that. 10 minutes into it. I'm trying to keep the information shorter for you guys, because I know a lot of people, they don't want to really sit through a 2-hour-long video or even a half an hour-long video. So I'm trying to put all the information as close as I can to the very beginning of the video. So the first 10 minutes to 20 minutes of the video is where all the information is. And then after that, we can have the discussion about it. So again, this is how trying to understand how it is that the Federal Reserve is operating through their communication, since it's their communication that is the most important part of the economic policy, of the monetary policy. And that communication is, in the way it is not only presented, but then received, is also very critical to the outcome. It's not just the information about what it is, right? It's not just a matter of a rate cut. It's how the people receive the information about this rate cut. And whether or not they will have a inflationary expectation, or one that rises or one that falls. Right? Will there be more inflation or less inflation? There might be still inflation. It just might be not as grand of an inflation, less than expected. Who knows what the outcome will be when it's presented out there? Obviously, we'll figure that out at the end of the day, or the end of the time period, or whatever it is that they release the information and then revise it later. But, at some point we'll figure it out. Yeah. All right. Let's see. Let's cruise up to the top. Let's start reading through some of these comments. All right. Thank you for joining the channel, too. All right. We got Conan. Sounds like cuts, which I'm leaning towards. Can't say it's a guarantee. I wouldn't necessarily go as far as a guarantee, but what the market is going to be pricing in is 100% guarantee based off of some of the information that was presented. They didn't give a clear communication to how much they're going to cut. And they are still somewhat data dependent. So I guess there is always got the out to say, hey, data came in and, unfortunately the inflation was much hotter and jobs are just kicking it way better than we had ever expected it to. I mean, there could be something like that comes out, and, therefore the Federal Reserve may postpone it again, or delay, or just not do it. I mean, I'm not sure what it is that, postponing and delaying to me seems like it's an inevitable outcome that they are going to lower rates, which does make sense considering they're either raising or lowering them for the most part. But considering the communications that had now taken place into the mainstream media, it would be pretty difficult, or it would have to be pretty significant information, data to come out that would then reverse this narrative again, right? So I'm not necessarily convinced that it's going to be even going to be any cuts, but the communication that is coming to the markets now, that seems fairly clear now, right? The time has come for policies to adjust. Now, again, what does that exactly entail? Nobody knows, right? So the adjustment could be something so minor that, people are like, okay, well, that wasn't even doing anything at all. But then again, the adjustments could be quite significant and priced well into the market already, as a lot of people are considering anywhere from a quarter to a half a point cut as it is. So once the Fed gets there and they move, if the markets have already predicted a quarter point cut and they have moved in that position, when the Fed actually moves and does cut, nothing will take place. It'll be really the day before and the day after will be the same. And it will be 6 months to a year down the road when it really changes. Okay. How much of the Fed ownership foreign elites? Good afternoon, Kevin from Lakeland, Florida. I'm in. Do you think? Hey, all right. What I said comes true. Remember who told you so. Hyperinflation. Welcome, Matt. All right. Cutting rates adds to the money supply and it's pro-inflationary. The reason to do it is makes capital less expensive and can churn around hiring. No, I mean, I think it's accommodating, but I don't think it's necessarily inflationary, right? Because if cutting rates was inflationary, then the zero interest rate policy that existed within the economy for close to 10 years would have created an inflationary scenario. So, I mean, interest rates at zero for close to 10 years failed to produce an inflationary scenario, but yet a minor interest rate cut to the Fed funds rate, which still leaves it significantly above the neutral interest rate, is somehow going to be inflationary? Like, really? I mean, I could see how if it's the communication that lands at the market's perception that creates the inflationary scenario, but I don't see it coming from the interest rate adjustments. I mean, if the interest rate adjustments created inflation, then zero interest rate policy would have created inflation, right? The whole fact that the Federal Reserve even came up with a make-up strategy is because they're making up for the fact that they failed to achieve the 2% inflation. That's like zero interest rate policy, all the money printing, quantitative easing 1, 2, 3, and 4, expansion of the balance sheet from $850 billion to over $4.5 trillion failed to produce the inflationary scenario that the Fed was looking for. But we're to expect that an interest rate cut is supposed to be inflationary? I mean, I guess if the market perceives it that way, then the inflation expectation would elevate, and therefore it would be inflationary, but it's the inflation expectation coming from the market that's doing it. It's certainly not the interest rates, right? I mean, if it's the interest rate adjustment that's going to be inflationary, then we have to figure out why zero interest rate policy failed to produce an inflationary scenario. So that's, all right, like, I mean, that's like, you have to go and explain that. Now, I can explain why the zero interest rate policy failed to produce the inflationary scenario. Okay, I can explain all that. I understand why, because most of the money ended up as deposits on the big bank's balance sheet and never really got lent into the system, and so therefore it never really chased the goods and services. It did inflate asset prices, but it didn't really cause our wages and cost of livings to go up in a way that the Federal Reserve would typically be looking for when they say they're going for a 2% target. It failed. It failed miserably. Okay. And so, as in expectation is really the driver of inflation, and a lot of people don't want to believe it, but that's what it is, and they just want to think it's money printer. But the money printing is what creates the inflation expectation that eventually leads into the self-fulfilling prophecy of inflationary pressures. But it's all about perception. And it's like, once you filter through all the Federal Reserve's documents and you listen to some of the things that they were scared about, considering that they had run out of what they refer to as scope, right? And this is when the Fed funds rate hit the lower bound of zero. They could no longer adjust interest rates to stimulate the economy. And they were like, now what? Now what do we do? And Ben Bernanke was like, yo, I got this, guys. Let me tell you the story about a gold machine, right? And now we can use our words and our communications to put that perception into the market to get them to behave in the way that we feel is most appropriate for monetary policy. And it works. It totally works. I mean, I just think about that, what he said, right? The loosening could lower inflation expectations if the public interpreted this action as the Federal Reserve predicting a weak economy in the future. If the market perceived it as this is the reason why they're cutting rates, is because the economy is about ready to fail. It will have it would lower the inflation expectation. People would be like, recessionary pressures are coming, that's a deflationary scenario, and that would lower the inflation expectation if they believed the Federal Reserve was cutting for that reason. If the public instead saw a change as simply reflecting a more accommodative policy stance, inflation expectations would be expected to rise. I mean, that's amazing to think that the same action can have two outcomes depending on how it was delivered. Right? It's so good. All right. Let's cruise down here to the bottom. Did I see Lumberjack Landlord up in here? Man, really appreciate you joining the live stream today, brother. All right. Let's see. They exported most of the inflation to the war theater and foreign entanglements. We will have inflation when all these dollars stay within the U.S. border. I don't think so. Like I mean, even if they were to send all the dollars back, what I find, like, first, what would have to take place is you would have to eliminate all the dollar-denominated debt that exists outside of the United States in order for those dollars to come home. Because you think about it, if they want to get out of that dollar-denominated debt, and a lot of people say, well, they'll just default. You can't. That's not feasible, right? What's going to end up happening is that people who have issued out debt in dollars don't have anything to do with the United States, not our government, not our banks, not our corporations, not the people, nothing, right? But they've written contracts due in dollars. Now, those contracts get used as if they're dollars. Not only the dollars that the contract is being backed by are out there, but then these contracts get used like dollars as well. So you think about the huge amount of dollars that are being used outside of the United States when they can create dollars by simply writing contracts that are due in dollars. And these things get used to do transactions. So now when the dollars are demanded to pay off those contracts in order to get out of the dollar altogether, the demand for dollar is going to skyrocket. As the dollars that are being used to extinguish the contract literally eliminates more dollars out of the system, which even strengthens the dollar even more. So now when people say it's going to be this hyperinflation scenario, okay, we got to go through that first, right? We got to go through this elimination of the dollar-denominated debt, which is going to cause the dollar to go and strengthen more than anybody could ever possibly imagine, because there is far more dollar-denominated debt that exists out there than the dollars to pay it off. Right? I mean, this doesn't have anything to do with the United States at this point. This is all the people outside of the United States who look at the dollar and say, that's the currency we are choosing to use. Doesn't have anything to do with the United States except for that it exists, that's this currency. We are choosing to use this currency. It's going to be our contract, our business, our deal. Doesn't have anybody else involved in it. U.S. doesn't have any say. Federal Reserve Bank doesn't even know. Right? You want to read a good article on this one? It's called Dollar Funding Stresses in China, a Federal Reserve paper. Dollar funding stresses in China. They break this down in an incredible way, talking just specifically about China. Now, this same issue is taking place throughout many nations, not just in China. China has dollar-denominated debt. Do you know that? They have government bonds that were written due in dollars, not yuan, not yen, not renminbi, not rubles, not anything else, dollars, right? They have other currencies, but that dollar-denominated debt, that is such a big deal that nobody seems to be really talking about. When you hear about all these nations who are getting out of treasuries and they're dumping treasuries and they don't want the dollar anymore, don't believe them. They are getting out of treasuries to get the cash to pay their dollar-denominated debt. That's what they are doing. The fastest way to get cash is to sell treasuries. If you can't sell your product, if you can't sell your service, if you can't, come up with the dollars and you got dollar-denominated debt that is due because you've written bonds that are due in dollars and you don't have anything to do with the United States, how the hell do you get those dollars? You're going to have to start selling some of your assets. And the asset that gets you the cash fastest, treasuries. And so people dump treasuries when they're in desperate need of cash. And that's one of the reasons why you see so many nations who are doing it during that time. Okay? This is how we do it, right? We figure this out. Okay, we're 24 minutes into it. Let's answer a question or two, and then I'm going to call it quits. Got to go back in, go back to work. All right. Election over your cost of living. All right. Default is feasible when all the world unites against the one currency. All right, the dollar is like Obi-Wan Kenobi. If you strike it down, it shall become more powerful than you can even imagine. Yeah, right? Right? I mean, All Nighter gets it because, like, he listens to just about every single person on the planet, so I don't understand how it is that he misses anything out there, but All Nighter's got it right. It's like, the more you try to get rid of it, the worse it's going to get for you. Like, everybody get out of the dollar, and the dollar strengthens immensely, and all of a sudden you can't pay your dollar-denominated debt, and you got nations and countries and people and corporations and everything just crashing all around on this strengthening dollar because people are trying to literally get out of it. And it's creating chaos and misery. Right? King Dollar the Destroyer coming to destroy the world. If they try to get out of it, it will be punishing like they had never experienced. Right? People laugh at it. They think, oh man, we'll just get out of it and then poor United States will be out of it. It was like, yeah, I mean, if it truly ended at the very end of the day, yeah, that's true. But going through that process is going to be so painful and misery for a lot of people out there who are not expecting it. Yeah. Hyder is everywhere. Hyder is everywhere. I miss a lot, he says. Yeah. I don't believe it. All right, dollar is weakening, and it has been. Oh, damn it, I accidentally read one of Luther's comments. You owe me $5, Luther. All right. I don't think it's pain and misery because technology has helped the world out of our shadow. They can progress without us. Yeah, I can kind of agree in the sense that there is a lot more conveniences that we are experiencing today. And so when you think about the wealth of the individual, you got food, conveniences, and pleasures of life, right? That's wealth. That's what Cantillon describes as wealth. Food, conveniences, pleasures of life. If you got food, if you got all the food, well, or plenty of food, and you're not going hungry, well, then you got a third of the wealth taken care of. Well, then now what do you got left? Conveniences. Well, what's convenient? Like, kind of having a car is convenient, but yet Uber's convenient. Even a bus is convenient. Cell phones are convenient. There's a lot of convenience that people have, and just everyday average people, they don't need a car. You can find, ride share and all kinds of stuff. So the conveniences are becoming more prevalent as time goes on. And then what do we have? Pleasures of life. Well, hell, people get pleasure off of sitting there scrolling through TikTok videos, and they don't really even need a whole lot of pleasure outside of sitting in their living room, considering that people used to get pleasure by going out and interacting with each other on a regular basis. Pleasures of life is really all about what you are giving meaning to life to, right? So food, conveniences, and pleasures of life, I think this world, or not this world, but definitely this country is abundant in it. Like, abundant in those things. Everybody else is like, oh man, well, I don't have a house and a fancy car and a fancy vacation and all this other stuff. And you think like, that's like the meaning of life? Or is that a dive into luxury? Right? I mean, that's really what it comes down to. Food, conveniences, pleasures of life. What else do you need? That's it. That's wealth. After that, it's a luxury. What's happening, Brody? All right, did we get a super chat? We did. BuzzTune, thank you so much for the $1.99. Very awesome. How would balance the land we need for housing versus the land we need for farming versus the land we need for recreation? Correction. All right. So I don't know. I don't think you can balance it. I don't know if it's just like, how would I don't sit around trying to theorize on what it is that needs to be done in order to fix the situation, because I just don't believe there is any fixing of the situation, no balancing act, nothing that can be done like that. What we have is economic forces that are underlying that separates the rich from the poor, and it's better to understand why it's happening so that you can position yourself in a more appropriate fashion. I think about it. We were discussing it somewhat on a live stream last night. If you're depending on your age, you have all kinds of different opportunity when you are incredibly young, right? The younger you are, the more likely you have, not even the more likely, the better chance of having a good outcome just simply by following a simple process of moving money into a compounding interest investment. When you were young, small amounts on a monthly, even like as time goes on, just increase it. You do this on a regular basis without thinking about anything else. You go to work, you do your thing, you get your $50, your $100 a month, your $200 a month, whatever it is, and you're putting it towards it from a very early age, from 18 years old, and you go all the way until you're 65, and your outcome is going to be awesome, right? You have to pay a little bit of attention, make sure that you have it in the right spot, but having that compounding interest over the course of your life is by far the best way to go about it. You can be a complete dumb shit and still get away with it, right? And still end up with a good outcome on it. But by the time you're old, it's not the same game anymore. So trying to understand what it is that you need to do then has you understanding, okay, well, what's separating the rich from the poor, right? There's two people who live independently of the state. Well, there's three, but one of them doesn't really exist anymore, right? This is all according to Cantillon. My theories and a lot of stuff that I get, the economic forces, the underlying economic forces, I got out of this book, right? Cantillon's essay on economic theory. There's a link down in the description for you guys. And when you think about like what it is that's creating the inequality, right, that's going on, it doesn't allow you a whole lot of room to just kind of make up a strategy that's going to exist for everybody out there. Like there was a time when people could have a regular job, go out there, buy a house, have a family, raise it up, retirement, all the other stuff, and people are like, hey, where was that time? How do we get back to that? You're not going to. That's not going to occur, right? What's happening is that we have this huge separation between the rich and the poor, and all that middle class people that used to be able to go and buy the houses and stuff like that, they can't do that. That's the upper class that can do that now, or at least moving into the upper class. And so this wedge is being driven between the two, and as time goes on, it's going to get worse. So if you're not the person who is moving into property ownership, then you have to move into capital investment things like stocks and bonds and business or something out there, right? You have to move your money into a place that's going to come back to you. And so this becomes very difficult, as a lot of people are like, well, where do I go with it? Well, again, this depends upon you, right? You have to figure this out for yourself. If somebody on YouTube is telling you where to put your money, you put your money there. Now you have to listen to that guy to tell you to get your money back out again, because you didn't put it in there for your own personal reasons. You put it in there because it's some YouTube out there, some YouTube, right? That's not going to work out. Being the capitalist means that you know what you are doing with your money. That's what it means. It means I don't care what they say about interest rates. I don't care what they're saying out there. I have my own understanding of all this, and I'm going to put my money towards these things because this is what I feel is going to be the most appropriate for me. And that may very well be different for every single person, including everybody who is on this channel right now. So understanding that property ownership and being the capitalist, right? Getting a return on your capital investment. These are the only two positions that you are going to be able to go to in order to get yourself on the other side of the wedge, unless you are young. You're still going to be a capital investor, right? You're still going to put your money towards stocks and bonds or whatever it is that you're going to get your return from. But ultimately, you don't have to think about it. If you're young, you can just figure out, kind of understand a little bit of how your portfolio is supposed to work, and just be gung-ho, head, look down, do your work, put that money towards it every single month, and do that for the rest of your life, and you're going to have a decent outcome. But again, if you're not young, you're going to have to work at it. You're going to have to work hard at it, very much like I'm trying to figure it out for myself. People ask me all the time, what do I do? And I tell them all the time, I put my money in Bitcoin, I put my money in gold, I put my money in stocks, I put my money into some bonds, not a lot, right? I am trying to figure out where it is that I can place that money to get some sort of return off of it. And now I'm also today buying a house, right? So now I have the real estate part of things, and I'm positioning myself in whatever it is that I feel that I can now contribute to on a regular basis, right? If I can't think of anything to put money towards, maybe I'll make some more payments towards the house, because putting it towards the house cannot be a bad way to go, right? No matter what. If you're putting it towards the real estate, then that's not a bad decision, no matter what else. Like, if that's the only thing I did from now on, that would be a good investment in my mind, right? Even though I got a really low interest on it, and it's probably better to find a better place to have a return on it than to pay off low interest debt, but it's still not a bad place to go with your money. So to me, like, it's obvious. Like, you just keep your eyes out there and find things that are undervalued, unappreciated, and valuable, like silver. You know. All right. What time is it? I gots to go, everybody. I'm already starting to push it a little bit here. I just want to read one more comment here. I'll get it from All Nighter. Hey, Self, it's been a while, my friend. All right, you guys are connecting. I love it. Self-education, Simon. The prince equals the inheritor of modern times. Oh, okay, yeah. I think, like, you're thinking about, like, the inheritor of, like, generational wealth kind of thing. Okay. Yeah, I can kind of see that, if that's what you're meaning by it. 16 tons, and what do you get? Yeah, I don't try to sell. Just don't try and sell your soul to the company store. Yeah. Borders are in the house. All right, you guys, this was a lot of fun. We got 258 people watching with 103 likes. I hope you guys enjoyed the first 10 minutes of the information here in the live stream, where we were discussing how it is that the message of delivery to the public can then have their perception guiding them into an inflation expectation that either rises or falls, but the action they take could be the same. It's incredible to think, but yes, the communication coming from the Federal Reserve is far more important than their actions. And this is one of the things that we have been discussing here on this channel. And we are, let's see, we need to do a members only live stream. Let's do that tomorrow. You want to do it tomorrow? Let's do it tomorrow. Let's do it really early. If you guys want to join in on the members only live stream, I want to go over Michelle Bowman's recent speech, especially the monetary policy part of things, because it was given just 3 days ago. So it's going to give a good insight into what it is that the Federal Reserve is thinking from the FOMC's mindset. Now, again, it's just one member of the FOMC, but I think it's a good telling, speech of, like, at least the economic conditions that the Federal Reserve is witnessing at this time. So I think that's a good one. And then we might cover a bit more coming out of this particular makeup strategies paper. But again, it's 46 pages long. However, it's really, really, really good. So I encourage people to just go and read like the first 10 pages of it. It's like really good. It's hard to get through the Fed speak. So that part might be difficult. But anyway. Uneducated Economist. You guys let me know.